Welcome to The Explainer. Today, we are diving into a really interesting company, Zen Technologies. They're a defense tech player that has seen some absolutely explosive growth. But the big question is all that growth already baked into the stock price? Let's break down the analysis and find out.
So let's just start with this number, 55.8%. Just let that sink in for a second. That is the 5-year average profit growth for Zen Technologies. A number that huge, well, it definitely makes you sit up and pay attention. So let's dig in and start by understanding the world this company operates in. All right, first up, to really get a handle on Zen, you have to understand the powerful currents it's swimming with. We're talking about India's defense sector, and right now it is absolutely booming. There's a massive government-led transformation happening, and we need to look at what's fueling this and the unique challenges that come along with it. At the very heart of this boom is a huge push from the government. They're pouring money into modernizing the military, and with policies like Make in India, they're basically rolling out the red carpet for domestic companies to build and innovate. This isn't just a passing trend. It's a real structural shift in the industry. Now, this is where it gets really interesting because it's a classic two-sided coin situation. On one side, you have these incredible tailwinds, like the growing demand for simulation training, which, by the way, is Zen's specialty. But on the other side, you've got some pretty serious challenges, like a heavy dependence on government contracts. So yeah, you have this environment of huge potential, but also significant risk. So, in this high-stakes game, how does Zen Technologies position itself to actually win? Who are they exactly, and what do they really do? To put it simply, Zen builds the high-tech tools for modern warfare. Think hyper-realistic training simulators that save lives and save money, and maybe most importantly, advanced systems designed to counter one of the biggest new threats on the battlefield, hostile drones. And this breakdown of where their money comes from tells a very clear story. Training simulators, that's the lion's share, making up 60%. But look at that anti-drone business. It's already a quarter of their sales, and it's growing like a weed. It's a clear signal that they are betting big on next-generation defense tech. So how'd they get to be a leader, capturing a solid 35% of the Indian defense simulation market? Well, they've built some powerful competitive advantages, moats. They were early to the market, they've got strong relationships with the armed forces, and a lot of the time, they can provide solutions cheaper than their global competitors. Okay, so the story sounds great, and the strategy seems pretty solid, but do the hard numbers actually back it up? It's time for a little financial checkup. Let's pop the hood. And the company's report card is really a story of contrasts. On one side, you see truly explosive growth in both sales and profits. Those numbers are fantastic. But on the other side, the analysis points to some real risks. They rely heavily on just a few big government contracts, and that can lead to some inconsistent or lumpy revenue from quarter to quarter. But here's the thing. Despite those revenue risks, the company's underlying financial health is fantastic. You see high numbers for ROE and ROCE, which tells you it's incredibly efficient at turning investments into profit. And with almost no debt, well, this is what you'd call a fortress balance sheet. Okay, so we've got a market leader in a booming sector with a rock-solid balance sheet. This brings us to the most important question for any investor. What is a fair price to pay for this kind of quality and growth? This chart gives us our first clue. Zen Technologies trades at a price-to-earnings ratio of 28.5. That's over 26% higher than the average for its sector. In short, the market is already pricing this thing like it's a premium company. And the justification for that premium is pretty clear. The market isn't just being irrational here. It's willing to pay more because Zen's growth and profitability are, as we saw, just in a different league than its competitors. Now, a discounted cash flow analysis, which tries to figure out a company's value based on its future cash generation, gives us a range of possibilities. The base case, sort of the most likely scenario, puts the fair value at 750 rupees per share. Now, since the stock is currently trading around 695, this suggests there's some upside, but maybe not a massive amount. So, we've looked at the industry, the company, its financials, and its valuation. Let's tie it all together and see what the final verdict from this analysis is. The report lands on a buy recommendation, but, and this is very, very important, it comes with a strong dose of caution. So, it sees the potential for sure, but it is not a blind endorsement.
And that caution is all about these key risks. The high valuation means there's just not much room for error. If growth disappoints, the stock could fall pretty hard. And its heavy reliance on government orders and the constant threat from new technology are risks that you just cannot ignore.
And that really brings us to the core question this whole analysis leaves us with. Zen Technologies is a clear leader in a high-growth field, but how much is too much to pay for that quality? It's the essential puzzle that every investor in a company like this has to solve for themselves.